let's get started. And let's go to slide 3. Virtual meetings were already catching on before the pandemic, but use skyrocketed when COVID-19 and related travel and gathering restrictions hit. At this point, virtual meetings are here to stay, with some in hybrid form, others in virtual formats. And when I say hybrid, I mean where you have both a in-person and a virtual option. So let's start off today's presentation with some virtual meeting pointers and go to slide 4. It's important to review the current law of the company's jurisdiction of organization. That's especially the case where emergency orders were relied on in the past. Determine how to comply with any requirements specific for virtual meetings, such as making the shareholder list available for inspection in a virtual meeting context, and be sure to check the company's governing documents. Coordinate in advance if you have any shareholder proposals being voted on with the proponent, because you'll need to go over the logistics for presenting the proposal at a meeting. And remember that Reg FD applies in the virtual meeting context. And that means if you have a technical difficulty and it winds up that for a portion of the proceedings, only some people can hear what's going on, well, then you're going to have to assess whether any material non-public information was disclosed at that time. And if that happens, you'll need to take appropriate Reg FD steps, such as a press release or a Form 8K. I suggest you book your third-party providers well in advance. And even if you have a few years experience by now with virtual meetings, build in time for dry runs on the virtual platform that you're going to be using this year. Slide 5, please. In terms of disclosures, the proxy statement needs to have all necessary information for shareholders to attend and vote their shares at the virtual meeting. And by this, I mean technical requirements for assessing the meeting, any required documentation, and any differences there may be in procedures for record holders and beneficial holders to participate and vote at the meeting. And it's also helpful to note in the proxy statement when the website's going to be open to log in. And if there's going to be a phone number or email address or chat feature available to help resolve technical problems. You also may want to disclose how the Q&A is going to be handled. So can questions be submitted in advance? Do they have to be? Slide 7. The NYSE has always required a voting cast standard when shareholder approval is a prerequisite to the listing of additional or new securities, and that's not changing. But historically, the NYSE told companies that abstentions had to be treated as votes cast, even if that wasn't what state law or the charter and bylaws provide. So in effect, the NYSE was making abstentions the equivalent of votes against the proposal. Now what they've done is they've proposed an amendment that would specify that the company would calculate votes cast in accordance with its governing law in any applicable state law. So if you're conducting a shareholder vote under NYSE rules this year, and that could be, for example, approval of an equity incentive plan, that's a proposed amendment that you should be monitoring. Slide 9, as is usual, most companies had their say-on-pay proposals pass, and that often was done with very high support. But every year there are some failed proposals. And what I want you to keep in mind is that a negative recommendation from the ISS, while it likely will lower the level of support, it doesn't necessarily mean the proposal will fail. And you can choose to reach out to your shareholders to respond to an ISS recommendation, but you have to remember that to do so, you're going to have to file prepared materials with the SEC, and that includes speaking points, just even bullet points. They have to be additional soliciting materials filed on the day you first use them. Slide 10. terms of perks, that's an area that's still in the SEC's crosshairs. It's continued to bring enforcement action over undisclosed perks. So you want to be sure you have disclosure and internal controls in place that are sufficiently robust so you identify all perks that are required to be disclosed. I also want to mention that in the COVID context, the staff has provided guidance indicating that it's not generally a perk for a company to provide enhanced technology to make an executive's home the primary workplace. On the other hand, health-related or personal transportation benefits to address COVID-19 risk may be perks if not generally available to all employees. Slide 11. If COVID-19 impacted 2021 compensation decisions for executive officers, and that could be, for example, adjusting a multi-year performance measure in light of the pandemic. Well, that's something that you need to explain in the CD&A. And be sure to expect a close scrutiny of that disclosure by proxy advisory firms and investors. So you'll want to look at that carefully. And there are some ISS FAQs in that area you may want to monitor. Slide 12, pay ratio. Here I'll point out that you only need to identify the median employee once every 3 years, but that's if the company reasonably believes there hasn't been any change in its employee population or compensation arrangements that would significantly change the pay ratio disclosure. So if the pandemic or anything else impacted employee population and compensation in 2021 in such a significant manner, the company is going to have to identify a new median employee for 2021, even though it's done it recently. Slide 14 now. Shareholder proposals, we're going to be talking about quite a bit right now because that's in the news. The SEC had amended Rule 14A8, which is the governing rule for shareholder proposals back in September of 2020. But following the change in administration, the SEC announced that it's going to consider amendments to the rule this spring. But for now, the 2020 amendments currently apply to shareholder proposals submitted for inclusion in a company's 2022 proxy statement. And the amendments revised the ownership thresholds, providing a tiered approach. So you can have different combinations of the amount of securities held and the duration for which they've been held to satisfy the ownership thresholds. And there is a transition period that applies to the 2022 proxy season, allowing shareholders that meet specified conditions to rely on the prior $2,000 for 1 year threshold. Slide 15. The amendments clarified that a single person can't submit multiple proposals at the same shareholders meeting. That's always been the case, but what the amendments specified was that was either directly in a person's capacity as the shareholder or as a representative. And another important feature of the amendments is that the required level of shareholder support that a proposal must receive in order to be eligible for resubmission at a company's future shareholder meeting was raised so that it's 5%, 15%, and 25% for matters depending on whether they were voted on once, twice, or 3 or more times, respectively, in the last 5 years. Slide 16, the amendments to 14A8 also prohibited the aggregation of share ownership. They require the proponent to be available to meet with the company, and shareholders, if they're using representatives to provide to make their proposal on their behalf, need to provide information showing they know what the proposal is about and they in fact support it. Slide 17. So now we're going to move on to really current events. On November 3rd, Staff Legal Bulletin number 14L was issued, and that rescinded 3 prior Staff Legal Bulletins, 14I, J, and K, and it reversed course on positions that the staff takes for the ordinary business and the economic relevance grounds for exclusion of shareholder proposals. As for the significant policy exception to the ordinary business exclusion, the staff won't be focusing on determining the nexus between a policy issue and the company. Instead, the staff's going to be focused now on the social significance, the social policy significance of the issue that's the subject of the shareholder proposal. And SLAB 14L called out human capital management proposals as an example of the new approach. So those proposals won't be excludable solely because the proponent didn't demonstrate that the issue involved was significant to the company. Also, the staff's going to be taking a measured approach to evaluating micromanagement arguments. And it advised that proposals that seek detail or are promoting timeframes or methods don't per se constitute micromanagement. And as an example of its new approach, SLAB 14L pointed to a recent no action letter where the staff didn't concur with the exclusion of a climate change proposal that requested the company to set greenhouse emission reduction targets where that proposal did not impose a specific method for doing so. And in this area, the staff's also going to be considering the sophistication of investors generally on the matter raised by the proposal. And it's going to take into account the availability of data and the robustness of public discussion and analysis on the topic. Slide 18. And as for economic relevance, SLAB 14L stated, I think we need to go back one slide. As for economic relevance, the SLAB 14L stated the proposals that raise issues of broad social or ethical concern related to the company's business won't be excluded even if the relevant business falls below the economic thresholds that Rule 14A8I5 specified. And as a consequence of these steps that SLAB 14L laid out and changed, it's likely going to be more difficult for companies to get ESG proposals excluded from their proxy statements. And that's a big point. So before we move on, I just want to ask the other panelists if they have perspectives they want to share on that point.
Hi, Laura. Yeah, I'm happy to jump in here to say that we may not see major, impact on proposal formulation until 2023, but later on in 2022, so past the spring 2022 season, we may see proponents testing the water with new proposal topics related to these evolving ESG issues.
Thank you, Bridget.
I would say too that I think what this means is that it's probably going to be even more relevant for companies to engage with proponents, especially on social policies, in order to discuss what the concerns are, see if a proposal can be withdrawn, because the likelihood of a no action request may be significantly lower based on this.
I think it'll be interesting to see this year if as many companies come in with no action requests to exclude, or if this new staff legal bulletin will be discouraging.
Yeah, all of those are relevant and interesting points. But let's move to the next slide because there's another point on SLAB 14L I want to mention. It did provide new guidance on the use of email for the submission of shareholder proposals. And as a technical matter, it also republished guidance from the rescinded bulletins relating to proof of ownership level letters in use of images in shareholder proposals. Given the sea change from SLAB 14L, as well as developments scheduled for later this week, I'm going to skip over a few slides and go to our first slide on proxy voting advice, which I think is slide 23. Yeah, the next slide after that. Okay, so what happened in 2020 was the SEC, again, before the elections, adopted amendments to the proxy solicitation rules that specified that voting advice produced by proxy advisors generally constitutes a solicitation under the proxy rules. So what does that mean? It means that potentially failure to disclose material information regarding that advice can be misleading in violation of the proxy rules. And the 2020 amendments also added new conditions to exemptions from the proxy information and filing requirements that proxy advisors typically have relied on. And that has a December 1, 2021 compliance date. Next slide, please. But what happened in June of this year, SEC Chair Gensler directed the staff to revisit these proxy voting advice amendments. And the Division of Corporation Finance then indicated that it won't recommend enforcement action in this area while the SEC is considering further regulatory action. And if the conditions are on the exemptions that are ultimately retained, the division won't recommend any enforcement action on that basis for a reasonable period of time after ISS resumes its litigation challenging the amendments, and that litigation is currently on hold. So let's go to slide 25, or the next slide, I think it's 25. Yeah, the November 17th meeting coming up in 2 days. The SEC is scheduled to vote on these proxy voting advice amendments. So in a couple of days, we'll have a better sense of what the SEC has in mind for proxy voting advice. And I also want to add that at that meeting, the SEC is scheduled to vote on final amendments for universal proxy for contested elections, as well as related disclosures in director elections. So we'll have to see if any of those amendments to disclose information for director elections will apply to the 2022 proxy season. So we'll have to take a look at that. So with that, I'm going to turn the program over to Bridget.
Great, thank you, Laura. And thank you to the Mayor Brown team for inviting me to join today. At Georgeson, we take an investor-led approach to our client advice and guidance. And when it comes to shareholder proposals and engagement trends, understanding your investors' views on these topics is really key to preparing for the 2022 season. So starting with a look back to the 2021 season as it's informative to the trends we expect to see next year, the three big headlines from 2021 that I'll go over today. One, we saw the highest number of withdrawn proposals this year when compared to the last 3 years. Two, there was a record-breaking number of environmental and social proposals that passed this season. And third, investors are increasingly focused on and using their support of ENS proposals to show their evolving views on these topics. And that has played out, and that played out in a variety of ways this season. So over the course of the next few slides, I'll discuss these three big headlines, their impact on the 2021 season, and how they tie in with a look towards the 2022 season. I'll also discuss other expected shareholder proposal trends and considerations for next year. Much of the data in my slides is gathered from our recently published annual corporate governance review, which is available on our website if you'd like to check it out. So here on the slide, 128% increase in withdrawn proposals this year. So the number, obviously is higher this year when compared to 2020. Governance proposals tend to see the least number of withdrawals because the targeted nature of these proposals, which often drill into enhancing shareholder rights, tends to afford less room for negotiation, meaning that proponents of these proposals tend not to negotiate. And then with an increased focus on environmental and social issues, many of the 249 were related to these topics. And there's really been a notable shift in withdrawals of ENS proposals as companies are realizing the importance of these issues to investors. Some of the proponents of these proposals are more flexible than others in their willingness to negotiate. So why is this information important for 2022? It's really good to keep this point in mind, especially about the ENS proposal withdrawal number, should you find yourself the recipient of an ENS proposal this year. Moving on to the next slide, we'll take a view to voted, not voted, and passing rates and average support. So on this slide, we see a full picture of the breakdown between E, S, and G shareholder proposals that went to a vote versus those that did not go to a vote. So overall, 787 proposals were submitted in 2021. On the left-hand side, this chart further details some of my points from the previous slide about withdrawn proposals. So here you'll note an inverse relationship of the blue and pink bars for governance as compared to environmental and social, where blue is showing proposals voted and pink is showing those that did not make it to a vote, meaning that far more ENS proposals were negotiated out before going to a vote as compared to governance. And then on the right-hand side, we examined the average support for voted proposals. So increases across all three categories. And really, we think that this illustrates the evolution in investor expectations when it comes to looking at ESG matters, which we've seen over the past two proxy seasons. In terms of who is driving these proposals and this proposal activity, on the next slide, we examine the breakdown of top proponents by type of proposal they submitted. So if we can move to the next slide. Great. So you'll likely see, very familiar names at the top of this list. The Chvedden Group drove the highest number of governance proposals in 2021, but there is significantly more weight in the ENS categories year over year, which we expect to see into the future. I'm going to spend some time now, really diving into the proposals across the three categories: environmental, social, and governance. So if we can move to the next slide. Great. So, my second big headline for 2021 was that there was a record-breaking number of environmental proposals that passed this season. Both social and environmental saw a significant increase, not only in average support, but also in passing rates. So the social passing rate went from 13 passing in 2020 to 20 passing in 2021. And environmental, 5 passed in 2020 and 13 passed in 2021 in the S&P 1500. What's interesting about the environmental piece is that actually only 36 environmental proposals that were submitted to companies in the S&P 1500 actually went to a vote. So 1/3 of the voted proposals actually passed this year, which is pretty significant when compared to previous years. So on this slide, we've captured the very high level view of the passing proposals by type, but taking a moment to examine one particular topic from each of these two categories, I think further pronounces the growing interest in these topics when it comes to the vote. So from a social perspective, workforce diversity focused shareholder proposals is a topic we've seen exponential growth in over the last few seasons. So in 2019, 15 such proposals were submitted, and this year, 90 such proposals were submitted. Likewise, average support for these proposals has increased dramatically. Approximately the average support in 2020 for these proposals was 35%, and it was 55% in 2021. 4 passed in 2020 and 6 passed this year. So, exponential growth in that regard. From an environmental perspective, prior to the season, the nonprofit series had recorded only 3 climate-related shareholder proposals ever receiving majority support at US major oil companies. That number has almost tripled, with 5 proposals at 4 major oil companies having received majority support for related proposals in 2021. All 4 of those companies were targeted by Climate Action 100+, which is an investor initiative focused on climate change, which continued to gain momentum in 2021. Notably, 2 large investors, State Street and BlackRock, became signatories of Climate Action 100+ prior to the 2021 season. We cannot talk about the full spectrum of the shareholder proposal landscape from 2021 without discussing governance proposals, which I'll do on the next slide. So if we can move to the next slide. Great, thank you. So here is a detail on the performance of governance-related proposals, which is largely consistent with prior years. So on the left-hand side, we have a breakdown of proposals voted by topic, and then on the right, the proposals that passed within the governance category. You can see that on this slide that proposals relating to majority voting standards and action by written consent accounted for a majority of passages. And what I would note about written consent proposals as compared to those relating to the right to call special meeting is that written consent proposals are often focused on the adoption of the right, which is not yet a majority practice in the S&P 500, whereas those addressing the right to call a special meeting are often focused on amending existing rights, such as the ability to lower the threshold necessary to call a special meeting. Interestingly, this year in 2021, no independent chair proposals passed, where we did see 2 passing in 2020. The reason I've spent a moment really drilling into the detail of the outcomes of these proposals is that as you prepare for 2022, what is notable about the breakdown of the number of passing proposals across the E, S, and G categories in 2021 is that of all the proposals that passed across those 3 categories, 54% of passing proposals this year were related to governance topics, which said another way means that almost half of the passing proposals this year were related to environmental and social topics, which is really a major shift in the passing breakdown year over year. And it's just something to be mindful of going into 2022. If we could move on to the next slide, thank you. So my third and final headline for the 2021 season and how it relates to 2022 is that investors are increasing their focus on and also their support of E&S issues. And that played out in a variety of ways this season. I'm going to focus my comments on the 2 tables here on the slide. This information is gathered from NPX results from the past 3 seasons provided by Insightia, and it indicates the percentage of times the investor voted for this particular shareholder proposal matter. So the top table related to environmental topics. So this is the percentage of environmental proposals voted for by the 4 large investors listed on the slide. While State Street had more incremental increase in support this year after really changing their viewpoint on environmental matters in 2020, BlackRock, Vanguard, and Capital Group all appear to have major shifts in 2021. In line with its revisions to its voting policies indicating its intention to increasingly support shareholder proposals relating to material ESG issues, BlackRock, markedly shifted its voting practices this season, and looking at all environmental proposals that it voted on during the 2021 season. BlackRock's recent global stewardship report indicated that it actually voted in support of 64% of these proposals across the globe. Again, that's a global number, while the chart here on the slide relates to US companies. Similarly, Vanguard recently released stewardship report indicates that globally, it had supported 37% of environmental proposals and 43% of climate-related proposals. And then the bottom chart there in teal, that table indicates investor support for diversity proposals, and really across the board, you can see that the investors we looked at, increased support year over year. One thing I think that's interesting about this is that State Street, which has really popularized this issue, launched the Fearless Girl campaign in March of 2017, was actually one of the least supportive investors that we captured here. The reason it's important to analyze and look at this investor voting detail is because shifting investor voting behaviors will impact the 2022 season. Obviously, investor voting behavior are shifting due to changes in their voting policies, which are much more closely aligned with their evolving views on ESG topics like human capital management, diversity, and ESG disclosure. As you prepare for next year, it's really important to closely review voting policies in advance of the season, in addition to the policies released by ISS and Glass Lewis, and how those could impact the outcome of shareholder proposals or other matters that go to a vote at your meeting. And we closely track policy changes if you ever have any questions about those. If we can move on to the next slide. Thank you. So beyond the topics I've discussed, thematically, we don't expect significant changes in shareholder proposal activity for 2022. And as you're preparing for your next annual meeting, I'd encourage you to examine shareholder proposal activity, obviously from your company, but historical look back perhaps at your peer companies could be informative as well. Some additional things to consider listed out here on the slide. Scorecards are increasingly used by proponents to identify vulnerable companies, and could lead to shareholder proposal submissions. Some expanding scorecards I'll just touch on quickly. So As You Sow has a new corporate plastics pollution scorecard. They've also incorporated the concept of environmental racism into their racial equity scorecard, which essentially is looking at the environmental impacts of companies' operations in low-income and minority communities. Climate Action 100 Plus, I previously mentioned, so they launched their company benchmark prior to the 2021 season, and then they've recently released an update this fall. So good to look at their updated information and note if your company is on that list, you will likely potentially could be a target for a shareholder proposal in 2022. Glass Lewis has a proprietary ESG rating that in partnership with BitSight and Arabesque, they're going to actually be adding ESG information into their 2022 proxy papers. So would be good to familiarize yourself with what that looks like and understand that for your company. I would say another topic to look for in 2022 is the evolution of the Say on Climate proposals, which we expect will be delivered as climate transition plan proposals in 2022. So Say on Climate was a new topic in 2021, received a lot of attention and relatively high support for a first-time proposal, but none of those proposals passed. And due to various investor concerns about accountability of the Say on mechanism, the proponents spearheading the campaign have dropped the Say on element of these proposals and are interested in transitioning to a focus on climate transition reporting. So that proposal did receive strong support in 2021, and we expect strong support in 2022. And finally, we may see proposals related to ESG impacts on risks to to supply chain. The next slide is on, great. Just one other shareholder proposal topic that I didn't touch on earlier was political spending. Political spending remained high on investor agendas this year, and we expect similar performance in 2022. The reason I've put these two historical charts on the slide, the chart on the left shows that investors are increasing their support year over year. So the navy blue across most of the investors actually has grown year over year, meaning that they're more supportive year over year, and just something to note. So if we go to the next slide. So my final point on what to consider for the 2022 season is related actually to director elections. My comments thus far have been about the 2021 shareholder proposal landscape and outlook to 2022. But another view into investor expectations going into 2022 would be through the lens of director election voting. So we noted in our research for our annual corporate governance review that amongst the big three this season, BlackRock and State Street voted against more directors in the S&P 500 this year than in years past. In other words, their votes against are growing each year. And as we look to 2022, topics like diversity across the entire organization, as well as board oversight of risks related to environmental and social topics, will be areas of focus for not only BlackRock and State Street, but many more investors. And it's really important for companies to be aware of, evolving investor voting policies going into the new year and how these policies will impact, not only the shareholder proposal landscape for your company, but also potentially director elections. I actually think that's a really great segue for our next speaker, Christina, who will be talking about bigger picture implications of ESG topics such as diversity policies, voluntary disclosures.
Thank you so much, Bridget. That was really interesting information. And as you said, yes, a great segue to what I want to talk about today, which is SEC ESG disclosure considerations in planning for both preparing your 10K and your proxy statement. So I thought it would be helpful to start out by talking a little bit about what's going on at the SEC with respect to ESG. And as Laura mentioned in her presentation, there were a lot of rules that were adopted during the last administration, and I think it's very relevant to go over just the differences between sort of the view on disclosure from the last administration and the majority of the SEC in this current administration. So during the last administration, several rules were adopted that amended Regulation SK and disclosure requirements, focusing on providing company-specific, tailored information that allowed investors to view the company through the eyes of management. And I think that with this new administration, the focus is much more on providing disclosure that is consistent from year to year and comparable between companies. So we're really going from a more principles-based disclosure approach to something that's more prescriptive. So that, I think, just provides a little bit of context, not only to disclosure requirements generally, but specifically with respect to ESG. So to go over some of the recent events at the SEC, the Division of Corporation Finance recently started sending out climate change comment letters to companies. And while there are no new rules at this point with respect to climate change disclosure, the sample comments were published on the SEC's website, and they focus on the Commission's 2010 climate change guidance. And so still with that principles-based disclosure focus of, is this information material to your company? And so I think this is something that companies should not be ignoring, even if they think it's not applicable to them, because you might get that question. And even if it's not material, you should be prepared to have an analysis for why it is not material to your company. So I think important before filing your 10K this year, reread that 2010 guidance, read the sample comment letter, and have the conversations with the disclosure committee about whether or not any of this information may be material. Is there any updating that needs to be done if you have a more generic risk factor touching on climate change or any climate change disclosure throughout your filing? Consider whether are you filing or providing disclosure about climate change outside of your 10K. You need to think about the relationship between your disclosures everywhere and where the appropriate disclosures belong. So in addition to the Division of Corporation Finance asking questions, we know that the Division of Enforcement has a new task force focused on climate and ESG. And the SEC says that the initial focus will be to identify any material gaps or misstatements in issuers' disclosure of climate risks under existing rules. So again, just emphasizing the point that the Commission is focused on climate change disclosure and ESG disclosure more generally, and you really want to be thinking through if and how you provide that disclosure this year. So as I mentioned, there is no new rulemaking for you to be aware of, right? There's no new disclosure requirements. However, I think that's not going to be true for very much longer. There is rulemaking on the horizon. The SEC has announced that it has put certain rulemakings on its agenda related to ESG disclosure. So first, disclosure relating to climate risk. We expect that could come out, the proposal, at any time. They had targeted October of this year, but we haven't seen anything yet. So it really could be at any time. In addition, disclosure relating to human capital, including workforce diversity, and we'll talk a bit more about that later. And also disclosure relating to corporate board diversity. So these are the areas specifically that the SEC has singled out in the ESG space where they are going to propose rules. And just to point out, it won't be something that's immediately required to be disclosed. It will be subject to the full APA process, and so there will be a proposal, a chance for the public to comment, and then an adopting release that implements the rule. So there will be some time before this disclosure is required, but it is important to start thinking about it now with a view towards the fact that you'll likely have to disclose further information in this space in the future. So if we could move to the next slide, please. Okay, so now I wanted to talk a bit about disclosure strategy, and I alluded to this before. ESG disclosure is provided often in not only the Form 10K, but in the proxy statement and in additional reports like a CSR report. So it's important to think through, if you are going to provide ESG disclosure and you're going to provide it in one or more of these publications, how do you decide where to put it? So with respect to the Form 10K, many companies have an interest in limiting the ESG disclosure to that which is material. And so I'll note, with respect to the recent adoption of amendments to Regulation SK, this is the first time we've seen mention of human capital in the SEC's rules. And I'll note that it is qualified by a materiality standard. And so what that means is, it was always required to be disclosed if it was material to your business. This isn't, the fact that it's now a line item doesn't mean that it's a new requirement, just that the Commission has recognized that for many companies, especially since the last amendment to Regulation SK, this information may be material, and so it's something that they wanted to put in the regulation for companies to consider. So in this past year, many companies appear to have added disclosure in response to the amended rule. And since this was the first year that many companies provided this disclosure, it's fairly varied and it's company specific. And so it's not as though there were many previous examples for companies who hadn't disclosed this information prior to look to. And so it really was an exercise in thinking through, what human capital measures or resources are material to your company and how should those be disclosed. And so we saw a lot of different topics, including diversity and inclusion, employee development and training, workplace safety, headcount data, which varied from being just numbers of employees to much more extensive data around geography, part-time versus full-time, and employee benefits. And so the 10K wasn't the only place, though, we saw increased human capital disclosure. I think a lot of companies provided it in their proxy statement as well. Maybe information that isn't material to how they run their business, but stuff that companies nonetheless wanted to highlight to their investors. And the proxy statement is often used as an opportunity to provide that type of information. So you can talk a bit more about the importance to the company, about being a good corporate citizen and what they do in the ESG space, environmental efforts, et cetera. And the disclosure is usually drafted in a way to communicate the information to interested shareholders without implying that it's important to how management runs the business, or without putting specific goals that the company will be held accountable for. And then, lastly, I say corporate social responsibility report on the slide, but I think this could apply to any report, whatever you want to call it. But it's another opportunity to provide ESG information that is not material, but maybe of interest to investors and other stakeholders, right? You get questions from not only investors, but others in the community who want to know more information about ESG efforts, and a CSR report is a good place to provide that type of information. If we can move to the next slide, please. Thank you. So I just wanted to go over in a little more detail the amendments to Regulation SK that focus on ESG concerns. And so we talked a bit about the human capital line item, and again, it's to the extent material, and its measures or objectives that the registrant focuses on in managing the business. So again, at the time this was adopted, the focus was supposed to be on, what is it that management considers important in running the company that shareholders should know about in the human capital space. So I think we expect we're going to see, again, more prescriptive disclosure requirements with a new human capital rule. But for now, it's the requirement is much more tailored to the company specifically. And then I'll note also there is a requirement for the material effects of compliance with government regulations, and the requirement specifically references environmental regulations. So just additional language in the description of business requirement to be aware of and to consider when drafting your 10K disclosure this year. If we can move to the next slide, please. Okay, so now I wanted to talk about board diversity requirements. And so very recently, the SEC approved NASDAQ's proposed rules requiring that NASDAQ-listed companies have or explain why they do not have a certain number of diverse directors. And so NASDAQ took a comply or explain approach, and depending on the size of your board, you have to have at least one director who self-identifies as female, regardless of designation at birth, and at least one director who self-identifies as either an underrepresented minority, as defined in the rule, or as LGBTQ+. And in addition to these requirements, NASDAQ-listed companies are also required to annually disclose directors' self-identified gender, race, and ethnicity, and LGBTQ+ status in their standardized board diversity matrix. I think Jen might touch on this in her slides, but this is something to consider with respect to your director and officer questionnaires as well. Next slide, please. Okay, and then lastly, the California board diversity requirements. And so there are two separate requirements. One for all publicly held corporations whose principal executive offices are located in California. So that's broader than just companies incorporated in California. Again, a requirement to have at least one female director, and then a separate requirement to have at least one director from an underrepresented minority on their board. So considerations are that the number increases as your board size increases. The California Secretary of State publishes a yearly report that tracks compliance, so that is available on the Secretary of State's website. And fines are imposed for regulations or for violations, and companies could face reputational risk as well for non-compliance. So with that, I would like to turn it over to Jen to touch on a few more specific matters for this coming proxy season. Thank you.
Great, thanks, Christina. So as Christina mentioned, I'm going to highlight just some final points here before the close of our program. And one thing to start with are DINO questionnaires. So as Christina mentioned, the NASDAQ diversity rule requires comply or disclose, but it also requires a diversity matrix in proxy statements. And although the diversity rule itself and related disclosure doesn't go into effect with this proxy statement, the diversity matrix is required for 2022 by the later of August 8th, 2022, or the date the company files its proxy or information statement for its annual meeting. And NASDAQ has included examples of what they think are acceptable disclosures on its website, including showing the matrix that NASDAQ included in its proxy statement this year, and that's posted on this slide. So what we are recommending is that companies include a diversity question in their DINO questionnaires to collect information from directors for use in the proxy statement or other SEC filings, and for use in other public documents or in responses to investor inquiries. And again, on its website, NASDAQ has provided a sample diversity question that companies may use. But each company will need to work separately with legal counsel to determine whether additional enhanced questions may be required if they're located, for example, in California or another state that may be considering a board diversity rule. And please also make sure that you work with data privacy counsel to ensure that the questions that you ask comply with legal requirements where the directors are located. So as an example, there are certain EU countries that do not allow any such sensitive information to be asked of their residents. Certain US states as well require questions to include disclaimers or legends. So the California Consumer Privacy Act, for example, requires that directors be provided with a notice requiring the information to be collected. And finally, consider including your internal D&I team or your external counsel's D&I team to help draft the questions so that they include inclusive language. Next slide, please. So other updates to consider for your D&O questionnaire include questions regarding related party transactions. So as we previously published in April 2021, the NYSE amended section 314 of its listed company manual to require that the audit committee or other independent body of the board conduct a reasonable prior review of related party transactions. Although this initial amendment didn't take into account the transaction value threshold in SK 404, the NYSE did subsequently amend that rule to include that materiality threshold. So although prior review requirements are already effective, companies should consider whether any changes may be needed to the D&O questionnaires to solicit information regarding any potential related party transactions so that the board can comply with the prior review. And if the company has also made any changes to its related party transaction approval procedures, consider whether related proxy statement disclosure needs adjustment as well. And we provide the same reminders on this slide that we provide every year, but remember to update all dates, all look back periods, and review the D&O questionnaire responses carefully. Make sure you request follow-up information from your directors and your officers after reviewing the information and give them plenty of time to respond. Next slide, please. So for the last few minutes, I'll go through some reminders on recent changes to risk factors, MD&A, and other Form 10K disclosures. So first, as part of the modernization of Regulation SK in 2020, the Commission amended Item 105 regarding risk factors. So the highlights here are if a company's risk factor disclosure exceeds 15 pages, it must include a summary risk factor section of no more than 2 pages in the forepart of the annual report, or in a prospectus for a registered securities offering. Next, as part of the Commission's refinement of the principles-based approach to disclosure, the company should disclose the most material risk factors, which is a change from previously requiring the most significant risk factors. The amendments also require that risk factors be organized under relevant headings, in addition to the subcaptions that were previously required by the regulation. And generic risk factors, if they must be presented, should be placed at the end of the risk factor section under a separate caption. Next slide, please. And remember that risk factors must be tailored to the specific risks facing a company. The Commission has placed a particular focus recently on cybersecurity and data privacy disclosure and risks, and the SEC's regulatory agenda targeted this fall for proposed amendments to enhance issuer disclosures on cybersecurity risk governance. Other topics to consider updating for your risk factors include climate change. As we discussed today, quite a bit is another focus of the SEC. And many risk factors related to COVID-19 may need to evolve, particularly as a result of more certainty regarding the effects of the pandemic or as a result of vaccines and emerging variants. And of course, risks change for a company from year to year. A company needs to be particularly sensitive to areas where it's previously disclosed a hypothetical risk and subsequently an actual event named in that risk occurs. So in that circumstance, an update to the risk factor is needed, and it may be necessary to avoid securities law liability from misleading statements. And one area, again, where this is a particular issue that we've seen is in cybersecurity, and this is both for SEC enforcement purposes and for private litigation. This is becoming even more relevant as we see an increase in cyber attacks. Next slide, please. So moving on to MD&A disclosure, the 2020 amendments became effective in February of 2021, but companies were given until their first fiscal year ending on or after August 2021 to comply, but many companies have adopted early compliance. So we've listed on this slide some of the more significant changes to item 303, a new paragraph A to clarify the objective, the replacement of off-balance sheet disclosure with an instruction to discuss arrangements within the broader MD&A context, elimination of the tabular disclosure of contractual obligations, but addition of a requirement to disclose material cash requirements from known contractual and other obligations, and revisions to the results of operations section. And in addition, for interim financials and quarterly reports, the MD&A amendments allow companies to compare their most recent completed quarter to either the corresponding quarter of the prior year or the immediately preceding quarter. Next slide, please. So our reminders for Form 10-K are included on this slide. Remember that the requirement to include selected financial data has been eliminated, and supplementary financial data under item 302 of Reg SK was amended by replacing the requirement to provide 2 years of tabular selected data with the principles-based requirement. And finally, don't forget about new item 9C, which was added pursuant to the Holding Foreign Companies Accountable Act. And this applies not only to Form 10-K, but also Forms 20F and 40F. And the item applies to issuers that have been identified by the SEC as having retained a public accounting firm that the PCAOB has determined it is unable to inspect or investigate completely because of a position taken by an authority in that foreign jurisdiction where that accounting firm's office or branch is located. So if this is applicable, companies must provide documentation to the SEC that establishes, among other things, that the company is not owned or controlled by a governmental entity in that foreign jurisdiction. If it's not applicable, companies should still include the item number and just indicate that the disclosure is not applicable. Next slide, please. So finally, just a reminder about electronic signatures. Rule 302 of Reg ST allows for manual signatures or for electronic signatures on EDGAR filings, provided that certain procedures are followed. So before a signatory uses an electronic signature, he or she must manually sign a document attesting that the signatory agrees that the use of an electronic signature constitutes the legal equivalent of the individual's manual signature. And this must be retained for as long as the signatory uses that electronic signature and for at least 7 years thereafter. Next slide, please. So the required process for electronic signatures for documents filed in EDGAR is set forth in the EDGAR Filer Manual, but at a minimum, what we've listed here is that the signing process must require the signatory to present a physical, logical, or digital credential that authenticates his or her identity, reasonably provide for non-repudiation of the signature, and provide that the signature must be, provide that the signature be attached or otherwise logically associated with the signature page, and must include a timestamp to record the date and time of the signature. So just plan ahead and ensure that if you want to use electronic signatures on your annual report or other filings with the SEC, make sure you implement these procedures to comply with the SEC's requirements to the extent you haven't already done so. So that ends our webinar. On behalf of Mayor Brown, thank you for joining us today, and thank you to Bridget Rosati from Georgeson for co-presenting as well.